We are absolutely delighted to have Ken Fisher, the founder and executive chairman of Fisher Investments, on our show again today. Fisher Investments is a premier investment firm serving high net worth individuals, families, and institutional investors. Ken founded the firm in 1979, which now manages over $387 billion. Ken, it's a great pleasure to have you back on SomPro TV. Before we dive into the questions, how have you been? And looking back at the past year, what's been the most interesting or exciting development for Fisher Investments?
So first, thank you for having me. It's good to be back with you. Secondarily, I'm fine. The only real change since I saw you last was I turned 75, and so now I'm just officially an old codger. But all is good, and I think the most interesting part of the period since I saw you in 2024 and was with you is that which I successfully predicted in my Chosun Weekly Biz column, that there would be a transition from tech leadership to value leadership, heavily driven by banks and Europe and everything outside of America, but most particularly the areas that President Trump had targeted the most for tariffs. I underestimated how strong the South Korean market would be over that time period, but it was part of the world that I envisioned would outperform. So it's all been a good period, and that continues into 2026 with, of course, some volatility about all of the things that we've been hearing about recently, such as Iran.
Well, let's get right to the sort of 800-pound gorilla that's dominating the conversation right now is the conflict with Iran. Started a few days ago. How should investors handle this? What's the right playbook? I mean, I'm trying to think about the last time the U.S. was involved directly in a major conflict, 1991 and 2003. That was a long time ago. I think I was a young man back then. So how should investors think about this?
Of course, the United States has been directly involved in conflicts since then, including in Afghanistan and Iraq. But moreover, we have a very long history of regional wars and a very long history of stock markets. And we can say simply that regional wars do not create bear markets on a global basis at all. If you look 12 months after regional conflicts start, occasionally the market's down a little. Mostly it's up small double digits. The fact is, there's an age-old saying from before the modern era, sell on the fear, buy on the bullets. Today, the bullets might be replaced by bombs, but the same principle applies. Now, in this period, the South Korean market has been punished in these first few days of the Iranian conflict more than most of the world, partly in parallel, although seemingly non-related, to some of the concerns about AI, but also because South Korea is quite energy dependent. And energy dependent in particular from the Middle East countries, and fears and concerns about what happens if that Middle East oil does not flow out of the Straits of Hormuz. But I will just tell you, when you look ever since the Falkland Islands War in the 1980s, whenever Western gear has gone up against Eastern gear, it's been increasingly one-sided in combat. In this conflict, there is complete or relatively complete one-sidedness. The capability of the equipment that the West has is hugely superior to anything that Iran has. Already as we speak, most of Iran's defensive capabilities have been eliminated, and before long they all will be. If you believe the statements of the President of the United States, there is an intent to eliminate intermediate term and long range missile capability, any nuclear capability, drones, the replacement of all of those, and the Navy. All of that is fairly simple, ugly, but fairly simple to achieve. And after that, the world will roll along as it was before. This kind of stuff for most people is always scary, but I just want to point out the amazing capability of the technology that the West has today to deliver this brutality. And the fact that it is virtually impossible for this to go any but one direction, which is to neutralize the capability of Iran to be a threat to the rest of the world, either with oil, with bombs, military throughout the Middle East or any other way.
So it seems that the right strategy for investors, certainly investors with a medium long-term point of view, is you're going to see some volatility. There are going to be some headlines that are going to be scary. And what I found scary was as it turns out that one of President Trump's negotiators said the Iranians says we have enough material for 11 nuclear bombs right now. And when you hear something like that, you'd say perhaps we are successful, then the world might even be a better, hopefully would be a better place afterwards. So basically, sit tight and don't stick to your strategy would be the right way to go.
But let me make another point about South Korea. The president has said, which might be right, might be wrong, that this entire campaign should take 4 to 5 weeks to completion. So maybe he's wrong. Maybe it's 8 weeks to completion. Who knows? But South Korea has 7 months of fossil fuel reserves. So therefore, the temporary closing of the Strait of Hormuz and the inability of most of that Gulf oil to get out to the world is not an immediate predicament for South Korea as many think. It's a much lesser concern. And by then, part of the result of all this is to keep a permanent future world where the Strait of Hormuz is open so oil can flow to the world from not just Iran, but from the other Gulf Coast countries.
That's a very good point. So if there may be an opportunity to get into the South Korean markets for people who are not in or who are in and might want to add, if there's a little more sort of headline fearing sort of panic, that 7 months is actually quite a bit of reserves. That's a very good point. I want to move away from the war bit and and ask you for your outlook for U.S. stocks specifically, as well as sort of global stocks. Is it a time for, as you mentioned, you called it last year, is it still a time for sector rotation? And global outperformed last year, continues to outperform so far this year. Do we carry along with that for another certain amount of time? Because over a 5-10 year period, certainly the U.S. stocks have outperformed everybody, at least in the last 10 years.
So yes, in the last 10 years, that's true. If you go back through the very long-term history, you get these irregular waves where U.S. does better than foreign and foreign does better than U.S. Now, let me put that into perspective. I am just going to say very simply that if you have a period of some significant time where tech leads the world, the U.S. will lead, and some other countries will also. But if you have a period where tech lags the world, the U.S. and some other countries will tend to have difficulty with that. When value leads, it is also parallel to banks leading, or financial services generally. And that's where you get the most value-intensive countries as countries seeming to do well, which last year included the strength across the board in Western Europe. A market like Spain, which people don't think of as an exciting country in terms of its economics because it's so bank heavy, actually, had a 40% return last year. That's because of that strength. That momentum largely will continue intact at a lesser level this year. You asked about the United States. The United States remains a laggard, partly because its financial system is more strained, partly because of the tariffs, partly because the time for tech to lead the way it had for so long is now rolled over and will continue to be rolled over. You can't overestimate the degree to which tech has kind of run into a wall where on the high end where growth is most necessary, there's a real chip shortage. And to see that most clearly, you can listen to NVIDIA talk about their ability to meet the demand for what the AI world wants. The fact is, if you can't push the stuff out the door, you can't get the revenue. But this should be a good year. Expectations for Europe are particularly low, and Europe as an economy is doing better than that. Therefore, there's positive surprise there. Most of Asia is doing well compared to expectations. The period that we're in with the shift tied to the U.S. Supreme Court's decision on President Trump's tariffs associated with the grounds under which he originally substantiated them, leaves him to have these new global tariffs for 150 days, but those global tariffs actually have a little loophole in them, which is anything that comes from Mexico or Canada is, with very few exceptions, is tariff free. So this will help the Canadian market and help the Mexican market as other countries will move things into Mexico, transship them. It continues to be true that the U.S. Customs Border Protection Agency subset that is in charge of collecting the tariffs has almost no inspection capability. Last year, they inspected less than 500 shipments that came into the country out of millions. I just want you to see how little they're able to detect what I would call cheating on the part of foreign importers when they repackage and ship through a place like Mexico. Oh, one other point that isn't well publicized. The day after the U.S. Supreme Court decision, when President Trump initially said tariffs would be 10%, the following day, the Saturday, he said they would be 15%. You may remember that?
Yes.
He said that, but he never effectuated it. They're still 10%. That almost no one seems to see.
Now, net, would you say that the Supreme Court, though, and I think it was priced in perhaps 70% of the market, that they were going to overturn the tariffs, and they did. Is that net? Does that create more uncertainty for U.S. business and U.S. and hiring decisions and investment? Because at least with the IEEPA, you knew what it was, you knew what was there. Now he's got 150 days of a 10 to 15% tariff, and then he may try to find other ways to do it. Is that sort of an unwelcome kind of uncertainty for U.S. business?
Partially, but partially not. Let me try to put that in perspective. When the president started his original Liberation Day tariffs in April 2nd last year, the magnitude of that and the basis of it and the degree to which no one had ever done anything like that before in America was startling and scary, causing stocks to plummet hugely. As time moved forward after that, and Trump would wiggle on this, and he'd increase China, and then he'd drop China, and then he'd put a tariff on this, and then he'd put a different tariff on that other thing, and then he'd go and attack some other country, and he went after Brazil, and then he did this, and then he did that. Tariff after. People slowly start to take it less seriously. The fact is, where we are right now with tariffs, the actual sticker price on the tariffs is lower than it's been. It continues to be that the actual collection of them will be a small percentage of that. That's all good news. At the same time, the uncertainty that you talk about for after the 150 days is over is very real, but people take it all with a grain of sand, with a grain of salt, with a certain sense that this will all vacillate around, but it's not going to cause us the chaos that we once feared it would. And slowly over time, every bit of tariff terror that President Trump creates with his wiggles gets taken less and less seriously by everyone because they assume they just have to plan around it.
That's a very, very good insight. In terms of that, we are in a midterm election year. Certainly Americans know that, but some of our Korean viewers may not know that as well, and certainly most Americans could probably use a reminder. How do equity markets tend to, if there's a pattern, act in an election, in a midterm election year?
Well, let me give you the answer to that, and then let me give you the why. The answer to that is we have a very long history of midterms. Midterms happen in the November in between presidential elections every 2 years. In the beginning of those years, the U.S. market tends to grind sideways and gain only a little. Positive only a little more than half the time for each of the first few quarters. Then it takes off in the back of the year heavily. The midterms provide a form of relief. Let me take you through the why. First, in America and around the world, it is true that people hate losses much more than they love comparable size gains. Whenever we have big controversial legislation, somebody wins, somebody loses. In politics, in America in particular, the way people think, Hardcore Republicans will think if the Democrats win, it'll be terrible. Hardcore Democrats will think if the Republicans win, it will be terrible. That's pretty normal. That's more true now than it was 10, 20, 30 years ago because America is more polarized. In the primaries, in the early portions of a midterm year, candidates are running within their own party for the position to be the nominee of their party in the November election. And to appeal to their base, they make extremist pledges as to what they will accomplish if they're elected. That scares people. Both the Republicans do it and the Democrats do it. And it gets shrill and it scares people, and political risk aversion rises for fear of legislation ahead. Now, in fact, the midterms almost always take some relative or, in fact, absolute power away from the president's party. In the last 100 years, there have only been 3 midterms where the president's party, regardless of whether Democrat or Republican, didn't lose some power to the opposition party in the House of Representatives. A little bit less than that, 70% of the time in the Senate, but then the House almost 100% of the time. So in the early part of the year, there's this shrill fear of legislation. Once you get the nominees, and now they're Republicans campaigning against a Democrat, now they talk toward the middle. They don't talk toward the extremes anymore, and it starts to calm down. No one ever sees this because most voters believe if my side loses, it's going to be terrible. And their political bias blinds them from seeing this. But as the fear of big legislation fades, the market takes off. That history is, the fourth quarter of midterm election years is positive 88% of history, with an average return of 8% just in the quarter. Wow. The fact of the matter is, this is because if you look at U.S. history going back longer than 100 years, but I use 100 years because that's the length of good S&P 500 data. If you look over the course of that history, all big and controversial legislation happens in the first 2 years of president's terms, none in the third and fourth year. And that leads into the third year being overwhelmingly positive. There hasn't been a negative third year of a U.S. president's term since 1939, going into World War II. And that year, 1939, was only down 0.9%. The power of the midterm leading into a strong third year is pretty overwhelming. That might be the end of the bull market after that, but the power of midterm eliminating the ability for controversial legislation is a very powerful effect in American politics. And of course, if you think of the world, South Korea aside, coming back to South Korea, if you think of the world as a whole, the world has a correlation to the United States of 0.83, where 1.0, it means it would move in perfect lockstep. The world moves pretty heavily with the U.S. When the U.S. does badly, it drags the world down some. When the U.S. does well, it pulls the world up some. With South Korea, that's about 0.59 over the last 20 years, but that's still a significant positive impact.
That's actually wonderful perspective in terms of both the electorally and how it acts, how the market acts in the fourth quarter, and then the third year of the fourth year of the term. That's so it sounds as if we are in the bull market. We're probably in perhaps the second half of the game, if we want to use a sports metaphor. So it sounds as you think we'll grind a bit, finish the year up, finish the year next year well up, and then we'll have to see where we go from there. One thing I did want to ask you about is where we have a number of large IPOs tentatively scheduled for probably the second half of the year. Most of them are AI related. Maybe there's one or two crypto. And these IPOs right now, the market seems a little quite tentative and gloomy. Do you think these will actually come off? How will the market react to them? Will they actually be sort of euphoric and AI will come back, or is it actually they're going to IPO and then drop, as we have seen in previous, I remember Amazon or Facebook, I think it was back in the day, there weren't very good IPOs, if I recall.
So the granddaddy, of course, of all of those is SpaceX, which is not an AI company per se. But world of these mega unicorns is lined up, and as Elon Musk has said, he hopes SpaceX goes public this year. The reality is you don't really know. IPOs only go public when it's in the company's best interest for that to happen. They can plan for an IPO, and then if the market isn't right for the issue, they can pull it back at the last minute, and they do commonly. In 1987, in a book I wrote then, I coined the phrase, I said, IPO means it's probably overpriced. And the history of IPOs is that on average, a few of them end up being spectacular successes, and most of them end up being failures because they are priced for the benefit of the company, not for the benefit of the investor. The interesting feature about these IPOs in 2026, to the extent that they come public, is how are they received? You alluded to that. If they are received very well, that's a sign of budding euphoria, and that's scary. If they're received poorly, that's a sign that we still have wall of worry to climb in this bull market, and that's a good statement. A little like your reference to some of the early tech IPOs that didn't live up to expectations in the early internet cycle. What you should want to see is they disappoint, evidencing that the wall of worry is still intact, that the bull market has to climb before you get to a euphoric and overpriced market that it cannot exceed. So I would say you kind of look at it differently than most people think. You don't look at them hopefully to be successes if you want the bull market to continue. You look at them hoping that they actually will not do very well after the offering as a sign that we're not already euphoric. And therefore, there's still more bull market to run ahead.
It sounds so simple when you put it that way, but it makes a lot of sense. So in June, most likely, we will get a new Fed chair, Kevin Warsh, and certainly he seems like to have his work cut out for him. A lot of things to balance. Are you expecting anything unusual from the Fed in terms of the market? The futures seem to have priced in 1 to 2 rate cuts this year. Do you expect to see anything substantially different?
So I pretty much always am a critic of major central banks. There have been few exceptions to that. The one exception that I have with the U.S. Federal Reserve consistently is part of their job that no one ever talks about is as a regulator, and they're actually reasonably good as a regulator. But their monetary policy is usually not very good. They go about it in ways that are not the right ways to go about it, and that will be true whether Warsh is head of the Fed or not. The staff ends up having a big impact on the governors. It is still a process where the governors make the decision, not the head of the Fed, although the head of the Fed is a persuader, given ample opportunity to persuade and lead. We don't know how good he is at that. For the most part, when you look at heads of the Fed in history, they tend, not all of them, but most of them, have tended to be captured by the staff. And therefore, no, I would not expect the Fed to particularly do anything very unusual. Some people will say, and they might be right, that this one, having been so heavily vetted by President Trump, will be prone to want to do what President Trump wants done. But the fact of the matter is, once they're in office, once he's actually confirmed, and you said June, I'm not confident that it'll be June, but it'll be. I'm not fully confident that it'll be Warsh. I mean, he's got to be confirmed by the United States Senate, and that'll be a ritual that may go astray. Probably won't. Probably be Warsh being confirmed. But once that's done, he's got a full term, and he doesn't have to pay attention to Donald Trump anymore. And he will think about how will history measure him, and therefore he probably ends up doing relatively conventional things. Probably.
Where do you think there's a lot of, just briefly, where do you think the neutral rate should be? A lot of arguments about that. Some of the regional Fed presidents think it's here. Most people think it's perhaps another 50 to 75 basis points lower. Do you have a feel, if you could set interest rates, where do you think is the appropriate spot now?
So Milton Friedman was clear on this point when I was a young man. He was very articulate, although the phrase neutral rate was not used in those days. I mean, I'm talking about the 1960s, the 1970s, back when dinosaurs were floating around. And in that environment, what he said was, it is a mistake for the Fed to try to predict what should happen through interest rates because he'd already shown that doesn't work. That's part of the methodology that the Fed always does wrong, and so do other major central banks. What he said was, the central bank, the Fed's charter, is to control inflation and minimize unemployment. And the way it should go about that is to make an assumption about what it thinks the long-term real growth rate of the economy is, and pick the inflation rate that it wants, which the Fed has been very clear that it wants 2% a year inflation, and put those two together and have the broadest quantity of money grow at that rate, regardless of what interest rate generates that. Control the quantity of money, don't try to control the interest rate. So, for example, if you believe that the country would grow at 2.5% a year in real terms in GDP, and you wanted 2% inflation, you'd grow the quantity of money steadily at 4.5% a year, regardless of where interest rates were. He also said the Fed would never do that they just keep trying. He described them as like children at an amusement park driving bumper cars running into each other. They keep trying to estimate what would happen by setting the interest rate at this level. And when you do that, he would say you're controlling the wrong thing.
Why would, just briefly, why doesn't the Fed do what Professor Friedman said they should, and instead try to, I guess, accelerate, decelerate, accelerate, brake, gas, brake, sort of like you're in a traffic jam?
Because once they're in that position, they come to believe that they think they can. I mean, let me ask you a parallel, non-related question. Why do politicians lie?
Because they think that's what people want to hear.
And the central bank plays this game because they're the ones in the bumper cars.
Fair enough.
They become overconfident. They listen to their staff. Their staffs have all been trained in traditional neo-Keynesian economics. They actually all studied models that I studied as a kid and presumed when I was a kid were nonsense, that believe that you can predict what will happen to the economy by what you do to interest rates. If you just stop and think about that momentarily, you say to yourself, why would minor shifts in interest rates control what would happen to the economy? There are so many other variables.
I guess at the end of the day, it's what they feel that they can control, and it looks reasonable that that they're trying to be a great helmsman. Forgive the metaphor. Somebody else had that and it wasn't very complimentary.
And think about it differently. Add one more point. Let's say they did that and interest rates didn't go where the president or Congress wanted them to. They'd be subject to criticism because that's the way the president and Congress would think. Let's say they did that and they did what I stopped telling you Milton Friedman showed should be done. They just set the growth rate of the quantum of money and steady stated that and controlled for the growth in the quantity of money, not for interest rates. Whether interest rates were here or there or the other, there'd be plenty of people blaming them because people who want to borrow money would say, boy, the rates aren't low enough. People who want to lend money would be saying, boy, the rates aren't high enough. And they'd be subject to endless criticism. It's easier for them in some ways culturally to do it this way, but it's the wrong thing to do. So
if they actually wanted to go with Dr. Friedman's way of thinking, would they just not let interest rates be where they are and then expand and shrink their balance sheet to the size needed would be the right way to do it? That's great. Thank you, Ken, so much for your time today. Really appreciate the insights and look forward to having you back on the show again.
Thanks for having me. It was a joy. I appreciate it. You do a great job.
Thank you so much.